Imagine this, you're checking your bank account, expecting to see the usual depressing two-digit balance, but instead, there are millions sitting there. And not from winning the lottery or selling a kidney. It's from something called private equity. Sounds fancy, right? Like some VIP club where billionaires hang out. But here's the thing, private equity might actually be one of the biggest secrets behind long-term wealth. The kind of wealth where you don't even think twice about adding extra toppings on your pizza dot. So, what exactly is private equity? How did it work? And why do the richest people in the world treat it like their favorite game? That's what we're breaking down today, Dot. What is private equity? Think of it like Shark Tank, but with way bigger sharks and way more money on the line. Private equity firms pull cash from investors, think rich individuals, pension funds and institutions, and use it to buy companies. Sometimes they take struggling businesses private, fix them up, and later sell them for a huge profit. It's basically like flipping a car. Buy a rusty old one. Fix the engine, polish it up, and suddenly you can sell it for 5 times the price. Except instead of cars, these guys are flipping billion-dollar companies. How they make money, here's where it gets different from buying stocks. When you buy Apple shares, you're just riding along with millions of other investors. But private equity firms, they control the company, they can cut costs, replace the CEO, restructure operations, you name it. They're like house flippers, but for businesses. And no, this isn't open to everyone. You can't just send $500 and say, yo, invest this for me. Usually you need to be an accredited investor. Translation, at least $1 million net worth, or making $200,000 a year. For the rest of us, it feels like watching a party from behind the velvet rope. The famous strategy, leveraged buyouts, here's the main play. Private equity firms run the leveraged buyout, or they buy a company using a mix of their own money and a ton of borrowed cash. It's kind of like buying a house with a small down payment and a giant mortgage. If the value goes up, their tiny investment suddenly becomes massive profit. Of course, that makeover phase isn't always pretty. Cutting jobs, pressuring leadership, squeezing suppliers, it's brutal. And not every story ends well. Remember Toys R Us? Bought out, buried in debt, and eventually bankrupted. But then you've got wins like Hilton Hotels. Blackstone bought Hilton in 2007, stuck with it through the financial crisis, streamlined operations, and later sold it for billions in profit. That's the gamble. Sometimes glory, sometimes disaster. Why billionaires love it simple. The returns, private equity often beats the stock market. While your retirement fund might bring in 7 to 8% a year, private equity funds can deliver double that or more. That's why billionaires keep pouring money in, not just to get richer, but to stay richer than everyone else. Can regular people get in? If you're not sitting on piles of cash, there are still a couple of doors open. You can invest in publicly traded private equity firms like Blackstone, TKR, or Apollo. They're on the stock market, so technically anyone can buy their shares. Some new platforms are offering mini private equity style funds with smaller minimums. Think of them as the budget airlines of investing you still get on the plane, just without the champagne. But here's the catch. Private equity isn't liquid. Once your money's in, it's locked up for years. You can't just pull it out when you want. It's like marrying your money to a company until the firm decides to sell. The risks and myths private. Equity isn't a guaranteed money machine. Not every deal is a win, and not every manager is a genius. Some firms just load companies with debt and hope for the best. If it works, great. If not, employees, suppliers, and communities pay the price. Timing also matters. Buying low and selling high sounds simple, but predicting markets, recessions, or even unexpected global events is tough. The best firms survive because they adapt pivoting strategies. Going digital, or reshaping entire industries, comparing it to other paths private. Equity is just one route to wealth. Venture capital bets on startups. It's riskier, but can produce massive wins. E-commerce lets anyone with Wi-Fi build a brand, though competition is fierce. Service businesses like agencies or consulting firms are smaller scale, but can be very profitable compared to these. Private equity is elite, exclusive, and operates on a completely different level. Final take is private equity the secret to long-term wealth? For billionaires and big institutions, absolutely. For everyday people, it's less about joining the game and more about understanding it, because once you see how the big money world works, you start thinking differently about your own financial moves, whether that's investing, starting a business, or just recognizing risks others might miss. At the end of the day, private equity is risky, powerful, and sometimes controversial. It's not for everyone, but it teaches us something important. Wealth isn't just about hard work. It's about smart strategy, calculated risks, and knowing where the money flows. So What do you think? If you had the chance, would you jump into the private equity world? Or is it too much corporate drama for you? Drop your thoughts in the comments and don't forget to like, subscribe, and stick around. We've got plenty more money mysteries coming your way.